This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. My guest today is Michael Mauboussin. He is Managing Director and Head of Global Financial Strategies at Credit Suisse, where he advises clients on valuation and portfolio positioning, capital markets theory, competitive strategy analysis, and decision-making. He's also an adjunct professor of finance at the Columbia Business School and chairman of the board of trustees at the Sante Fe Institute. I first reached out to Michael, I believe in 2003, to ask permission to quote part of his work in my first book, Trend Following. He obliged. I think I first saw his work in the mid to late 90s. These great PDFs early on when he was at Credit Suisse and before he went to Legg Mason, and now he's back to Credit Suisse. Just fantastic. Even if you go back and find those old PDFs from Michael in the late 90s, they're timeless. And what he was doing, and it shaped me early on, was the multidisciplinary thinking, pulling from different parts of the world in academia and economics and sports and neuroscience, psychology, decision-making, investments, finance, you name it, Michael would pull from it. And I started to realize as I was getting into my trend following subject, I was like, wow, this guy's just opened up Pandora's box of what you can do, what you can reach for, what you can take from to help explain. And I was just so fortunate to be into a topic area, trend following, where this multidisciplinary thinking dovetails perfectly. It just fits like a glove. I'm always indebted to people like Michael. Many people have shaped and given me, so to speak, permission in my own mind to go down certain paths. And Michael is definitely the leader in the multidisciplinary thinking thought process that influenced me. I'm forever grateful for that. I hope you enjoy this conversation with Michael. So here's what I was thinking this morning. I was thinking, when was the first time I spotted you? And so I know officially I reached out in 2003 as I was writing a first book and I wanted permission to quote from your work. But I was thinking it must have been the PDFs that you're putting out in the, I want to say 96, 97, 98. And I was collecting them like trading cards because you were the guy, and I know you might say, well, somebody else influenced you, but you were the guy that was making it okay to put together this multidisciplinary thinking. And I look at my podcast now after 3 years, and it reads like a list that I would have programmed from you. It's like all the guys that I think, probably guys that you know, a lot of them, I'm sure. But I mean, how did that begin for you? Where did you start to say all these disparate, different things out there you're pulling together in one coherent vision? How did that begin for you?
Well, I think, first of all, that I think some people naturally think this way more than others, and it's not a good thing or a bad thing necessarily, but I probably am one of those people that more naturally thinks this way, so that's probably the first factor. But for me, the very distinct event was visiting the Sante Fe Institute. So Sante Fe Institute is a non-degree conferring institute that was founded precisely to go across disciplines, and my first visit there was in the mid-1990s, coinciding with the same time period, and their point was a lot of the most vexing problems in the world really lie at the intersection of disciplines. And while you need to understand the big ideas from each discipline, you really want to bring a full toolbox to all these kinds of problems. So that was the first thing, and then the second thing is I was reading in a wider and wider ring of things. I was one of those guys who would watch TV or read an article or read a book and start talking back to it like, no, wait a second, what about this? This is really important. As a consequence, I thought to myself, rather than me talking to my TV or my book or my article, perhaps I should start to write about this stuff. So that sort of encouraged me to be a little bit more systematic in trying to make these connections. So it's sort of one thing led to another. Is the best answer for that.
And the tricky thing is, it's not just the pieces, it's how the pieces connect to the whole.
Yeah, I think that's it. I mean, the idea is to say, when we go through life, are there things that are analogous that can be helpful in developing mental models, right? And so, are there things from physics can help us understand business, or psychology help us understand trading, or whatever it is? And often, psychologists do their thing and traders do their thing, and don't think about how these things might intersect with one another. So yeah, exactly. And the challenge is, it takes a little bit of time and effort to get outside of your little area, and often you might be reading things or thinking about things that are intellectual cul-de-sacs. They don't lead you anywhere. But what you're doing is building up a set of tools in your mind, so that when you're faced with a problem, you typically have the right tool to pull out to try to address that problem.
As I've seen you say, it's the larger reference class, not just you. Can you objectively, all of us, can we objectively look at ourselves and the situation? It's not an easy proposition, is it?
I think that's one of the best things we know from psychology is we tend to think of ourselves as unique. There's some good reasons for that. But in many cases, when you're thinking about decision making, it really does behoove you to look at larger reference classes and basically ask the simple question: what happened when other people were in this situation before? So there are lots of things we go through life, sort of first time for us, or unique or unusual, but lots of other people have been through it before. And so appealing to that larger population is actually very, very helpful, but it's not a natural way to think, which is really interesting. So you have to go out and really seek it and pursue it, and be very thoughtful about incorporating that into your mindset.
I thought of a real topical example would be the Swiss franc. And I saw one particular hedge fund, I don't remember the name, but apparently they lost a significant amount of money, nearly $1 billion. The larger reference class, that people could not imagine that quick of a move. But then again, if you take a step back, these types of moves have happened throughout history. So to not have that possibility in your toolbox, boy, if you're an investor and your manager, your trader is not thinking that way, that's a real cause for alarm, isn't it?
I agree with that. I heard that one of the large brokerage firms said that the event was a 40 standard deviation event, right? 40 sigma. Which basically says it would never happen. I mean, in effect, part of the reason they came up with that number is looking at about, I think it was 10 or 20 years of data, which is certainly not a rich enough data set. Right now, here are the sort of both sides of it, right? Because if you're trading, I'm telling you this, much more about this than I do, but if you're trading with a particular strategy that's serving you well, so you're making money generally, you're grinding out, it's all working well. The fact is, you probably feel like you've got a handle on things, right? And so you don't really want to introduce these possibilities of these extreme events. And as a consequence, people's, they're looking at data sets that aren't long enough or not rich enough. They're almost incentivized not to pay attention to some of that stuff until these sort of really adverse events take place. So part of it's the human nature element, which is you sort of feel like you got to figure it out. You're kind of doing okay. So why would I pay attention to this, what is deemed to be very remote possibility, albeit leads to wipeout, right? In many cases, we've seen, obviously, not just hedge funds, but other funds and corporations even be wiped out by these kinds of events because they simply don't have them firmly on their radar screen.
It's amazing. We're in 2015, but I immediately heard from some old pros about 1987, and they were talking about a euro-dollar move. So people that had been around, they were kind of like, hey, we've seen this game before. But like you said, if your data set's only going back a few years or maybe even a few decades, it's not enough to encompass everything that you should probably imagine could go wrong.
Exactly, and that's always, look, and this is now, I think, probably, really since Nassim Taleb wrote The Black Swan, but this idea has been around. Benoit Mandelbrot wrote about it in the 1960s, that if you do study a series of prices in almost whatever you want, commodities or currencies or even equities, or we do know that there are these relatively infrequent but very large scale events, and you have to take these things somehow into consideration when you're investing. And it might be through your time horizon. In other words, if you look back, then the crash in 1987 looks like a blip, So maybe it's just time horizon. It might be other ways of insuring against these sort of adverse outcomes. But you're absolutely right. And hopefully almost all investment professionals are aware of this now. But it goes back to what I was mentioning before. I think there are incentive issues. If you are doing well and you're getting well compensated without having to take these things into consideration, they're going to blindside you. Your incentives just don't allow you to introduce them into the thinking the way they should be.
Let me ask one more topical conversation or topical point for this particular conversation. So this fantastically I think if it's fair to say perhaps unexpected move in oil over the last 6-7 months. So when you look at your toolbox and you think about the various ways that you're analyzing markets, players, behaviors, how do you visualize, how do you think about, when you're just talking to yourself, how do you think about that oil move?
Well, I think there are two dimensions to this. One is, many commodities, I would start with the foundations of supply and demand. And I think that that is still a very appropriate way to think about these things. Now, certain commodities, and oil being one of them, these tend to be very slow cycles. In other words, if prices go up, the investment comes in, but it takes some time for that investment to click into place. Or if the prices go down, there's disinvestment, but it takes time. So this is moving a big ship around. So those supply, the supply issues may change at a rate that's much slower than demand and the price signals. So that's the first aspect, is I would still go supply demand. The second thing, which is really interesting, and Mike, I think you and I have talked about this over the years, is that what we know is there are in markets, there are nonlinear components to it, right? In other words, information may start to leak into the market and people start to think about it, but they're not weighting it very heavily. And then there's almost a flick of a switch, you start to see these fairly sizable moves. So it's not so much that there's anything that's particularly revealed that's new, but there's sort of a nonlinearity in price movements. And we see this, by the way, it's obviously in physical systems, these notion of phase transitions, which we see, the most straightforward one is going from 33 to 32 degrees Fahrenheit in water is a phase transition for the state of going from a liquid to a solid. But we see these also all over the place in social systems as well. So these are, they're popularized with concepts like tipping points and so forth. But these are very powerful phenomena. So when you combine, I think, to me, that story, my uninformed view of it would be a combination of those two things. One is the basic fundamentals of supply and demand, and how it's really hard to get your arms around lags. And then the second component is sort of the nonlinearity, which does tend to take people by surprise.
Well, you make the connection from your world perspective. You say, look, there's the fundamentals, and then there's the expectation or the price. We have to understand, all of us have to understand that those aren't necessarily going to be aligned at all times.
I love that point, and I just think that if you said to me, what is the single greatest mistake in the investment industry, I would say you just put your finger on it, right? Which is a failure to distinguish between those two things. And, the metaphor that's the easiest to grasp is a racetrack, right? Where you go to the racetrack and there are odds on the board, which is pari-mutuel bettors. It's a specification of the expectation of the performance of the horse. And then there's the fundamentals, which is how fast the horse is going to run. And so those two things, and by the way, in those cases, we run the race, so we actually know what the outcome is. And so it's very explicit. But in markets, you're getting the expectations of prices, so you have to basically reverse engineer from the prices what's expected in terms of performance. And what happens, I think the natural thing, and all of us do this, right? When things are going well, you both because you've done well typically if you're long, and psychologically you want to be part of it, right? And if things are going badly, you want to sell it. And so I think psychologically struggle because the price itself is giving us, it's not only giving us information, it's also influencing us. I think that's the key. So the price is influencing us in a way that blurs this fundamentals and expectations distinction. So I would just say the great investors, I think one of the characteristics of all great investors is that they always demarcate fundamentals and expectations, and they're very disciplined about it. And that's a really good lesson to learn, especially when you're young, to think about those two things as separately as you possibly can.
Yeah, of course, and from my world, there's some traders that just say, and I'm not trying to make a value judgment on one strategy or the other, but there's some traders that just say, by gosh, we're so confused by the fundamentals, we're just going to go straight to the expectation and just trade that.
Yeah, and I think that, part of it is, the reason I think it's actually an easier thing to do is because it's a little bit like, rather than guessing the score of a football game, you're just taking over-unders, right? So you don't need to get the details right, you just need to be sort of directionally correct, right? So if expectations are really, really lofty, all you have to say to yourself is, the probability they do much better is not high, the probability they do not as good, not well is high, so I'll buy it, or I'll put the trade on to take advantage of that. And likewise, expectations are low. So that's right, it's more like an over-under. It's like where the bar is set for the high jumper rather than knowing exactly how high the jumper can jump. All you need to know is where the bar is and the probability that person can clear it.
One of the things in the last couple of years, not the only thing by any stretch of the imagination, but you have really taken the mantle with the notion, the discussion, pushing the debate, pushing the conversation forward, the notion of trading profits, luck or skill. So as many times as you've talked about this subject, and I know you've talked about it extensively, I've listened to many of them. Is there something, a feedback or a fight that you hear from people? Are there people that hear that analysis and just say, "No, Michael"? Is there something is there something they miss and they want to fight? Because it's so damn logical and rational. So I want to know who fights you on this, if anybody.
Yeah. It's funny because I think that almost everybody to an individual can recognize it in other fields. So when you talk about some others, a sport, if you're a trader, you talk about sports, they can see it. But it tends to be, they tend to be a little looser when they're coming closer to home. No, I think what happens is for most of us, and there's a very fundamental reason for this. If you perceive that you're in control, so you're a trader and you've got your trading process and you're doing your thing every day, certainly everything about what you're doing suggests that you're skill, right? Because it's your volition. You're doing it. It's your process. You're putting the trades on and so forth. All your feedback is that's skill related. As a consequence, I think most of us, especially if you're successful, you're almost always going to naturally chalk that up to your skill. That your hard work and your effort and your process are what made it happen. The challenge is that this idea that we call the paradox of skill. I should be clear, it's not my idea, but we gave it that name. The paradox of skill says when you think about skill, you have to think about it on two levels. The first is absolute skill, right? Which is just how good you are, your tools, an athlete, it would be their athletic performance and so forth. The second way of thinking about skill is relative. I think the basic generalization we can make is as you look out around the world, that absolute skill has never been higher everywhere you look, right? I mean, athletics, in business, certainly in investments, right? We have access to incredible information and trading systems and computers and so forth, right? But at the same time, relative skill, I think, has also never been narrower, which is to say the difference between the very best and the average is less today than it was a generation or two before. Differential skill is less on average. I'm not saying it's gone away, but it's less. So as a consequence, notwithstanding our absolute level of skill has never been higher, more is being left to luck. And that's a very difficult thing for people to get their arms around, right? Or their heads wrapped around, I should say. So to me, that's the contrast, which is everything, you and I do our jobs and we're saying, well, we're doing it. It's us, right? And we're working hard and we're focused and we're trying to do the best we can. Everything about that says that it's skill, which is true. The problem is everybody else is doing the same thing. So when you're talking about dealing with markets and prices, that information for the most part gets expressed, and hence more is being left to luck. So it's funny you say that because I think people can, when you talk about luck in sports, for instance, all investors, they can see it and they can see it, they can understand the quantitative case for it, but it's much harder to do when you are thinking about yourself.
Are there any scientific principles of luck?
Well, it's a fundamentally important question to pose about definitions of luck. And, I won't go into it in any great detail, but, if I threw the word out luck, you often hear people talk about chance or fortune. And all these, of course, they have etymologies. They come from different places and they mean somewhat different things. So the first important thing is to define luck. The definition I settled on for the book was one that came from a philosopher. And he basically said luck exists when there are three conditions in place. One is it operates for an individual organization, right? So it happens to you or your trading book or your favorite sports team or what have you. Second is it can be good or bad. And the suggestion is not that it's symmetrical, but that there is a plus sign possible and a negative sign possible. And the third, and I think the vital one, which is it is reasonable to expect a different outcome could have occurred. In other words, if we rewound the tape of time and we play it again, it's reasonable to expect a different outcome. So when those three things in place, I think you have luck. And then with that little, if that's a valid or reasonable definition, then you start to think about what would you define as luck and what's not in your luck, right? So one of the things I like to say is skill is basically what is in your control, and luck is what is outside of your control. So there are all these great aphorisms about luck. When I tell people, I've done some work on skill and luck, they go, "Oh yeah, I know all about that. Yeah. Luck is where preparation meets opportunity." Or, the harder I work, the luckier I get, right? And these things pour out of people, and they of course have a very positive message, right? Which is work hard or prepare. And certainly those are messages we want to encourage, and we tell our kids those things, right? But if you accept my definition of luck, or this philosopher's definition of luck, those really aren't luck, right? You can't improve your luck. Those are things in your control, and hence they're going to, in our definition, are going to fall into the category of skill. So that's the way I like to think about it, and I think many traders think about it this way too, which is do everything you can within your power to succeed, and then understand that some days are going to be good and some days are going to be bad as a consequence of luck, things that are outside of your control. If you're an athlete, you focus on your preparation, whether what the weather is or how the referee does things. Those are things that are not in your control. So dwell on what you can control and separate yourself from things that you can't control, and then just move on. And there's this that great John Wooden definition of success, right, which is basically that you've done everything you can within your power. That is success. You've achieved all you can given who you are, and I think that's right. And everything else above and beyond that is what's outside of your control, are things you have to have almost a philosophical bent about them. Just take them as they come.
You mentioned athletes, and I was thinking of a great example. Of course, we can rattle off success stories in the fund management arena that were one big bet, and then there's a coronation that is now the superstar after one big bet. And I think what's really interesting in the most recent NFL game, Green Bay, Seattle, anybody that's watching that game, looking at the highlights, whatnot, easily could have gone the other way. But then once it goes the way of Seattle, instead of us really fixating on how fine a line it was and that luck was clearly involved, then there's the coronation. Well, Seattle's, they're on to the second Super Bowl. It's really interesting how we essentially rise. Once there's a kind of perhaps a lucky victory, we rise the winner of the lucky side up to this new pedestal, when the reality is it was pretty dang narrow.
Well, I think that, it's interesting that some NFL analytics websites have real-time probabilities of winning. As you're watching the game, you can see their real-time probabilities. And the Packers were well over 90%. So that game was, from a statistical point of view, close to being wrapped up. And you're exactly right. So if you do that scenario 100 times, I don't know what it is, 90 or 95% of the time the Packers win. The Seahawks win 5 or 10%. But it introduces, I think, some very, very important concepts that people need to be very aware of, investors and traders in particular. And I would say that the way I would think about it is, they're all related to outcome bias, right? Which is, once you've seen an outcome, so you know the answer, what all of us do naturally, effortlessly, is we create a narrative to explain that outcome, right? And then we follow it in our minds. And as we create that narrative, two things tend to happen. It very well describe what you just mentioned with this whole football game. One is called hindsight bias, which we start to believe that we knew what was going to happen with a greater probability than we actually did, right? Oh yeah, I knew all along that the Seahawks were hanging in there, whatever it is. And the second is called creeping determinism, which is we start to believe that what happened was the only thing that could have happened. And it's exactly as you said, these narratives, former Super Bowl team, the pride of the team, what have you, right? So we almost reshape our narrative to explain the outcome once we know the outcome. And it's actually a very, very dangerous way of thinking. By the way, it's very natural. I should be clear about that. And we all do it. Left to our own devices, we all create these stories. But this idea of outcome bias really clouds our ability to assess the quality of our thinking and the quality of our decision making. By the way, I mentioned even on the Packers game, if you look at sort of statistical approaches to football, the Packers had a couple situations early in the game where they chose to kick field goals versus going for touchdowns. Now, it was not a sure thing that it's 4th and 1 on the 1 yard line, or 4th and goal on the 1 line. It's not a sure thing you're going to score a touchdown. But it's an expected value, right? So let's say you score 50% of the time, it's 0.5 times 7, it's 3.5 expected points versus kicking a field goal, which is 3 points, whatever it is. And you just think about, they had two of those situations. Had they scored one of those touchdowns, we wouldn't even be having this conversation, right? So even along the way, these guys are making decisions that culminated to that sort of crescendo. Again, we just keep pulling out stories to explain what we've seen. And again, it's not just football; it's anything, sports. And as you point out, the one-trick wonders in investing. My point is, everybody, as I always like to say to people, someone's got every trade on at some point, right? So no matter what happens in the world, someone's going to look good, and others are going to look bad. Pointing to the person that did particularly want a particular situation is, first of all, you might applaud them, give them a little golf clap or something, but only if they can repeat that over time in some systematic fashion do you truly say that they know what they're doing. So this is another thing called the halo effect, which is we find success and then we go backward and say, what were those people doing? That's another very perilous way to think.
I was thinking, or I was mentioning it early in the podcast about guests on my show that perhaps I was inspired to ask via you, Daniel Kahneman, Vernon Smith, Daniel Simons, Laurie Santos, Barry Schwartz, Hersh Sheffrin, Meyer Statman. The list goes on. You're right there with them. So for yourself, many of your peers, all of this great behavioral work, and we can all go on Amazon, and there's fantastic books out there that basically just pick us apart. I mean, I love talking to Laurie Santos. She basically breaks it down to the monkey level, giving monkeys money, and it's kind of been figured out in many ways. Has it made a dent, though? Is it got into the general public consciousness, or are we at? Do you see where I'm going with that? I mean, where are we in that process of education?
It's a fascinating question and a very fundamental question, and I think that there's no way. I think it'd be very hard to argue that the general awareness of many of these principles is less today than it was 20 years ago. And so you say Kahneman, Tversky, and let's say where those guys really started to formalize a couple sets of ideas, heuristics and biases, and ultimately prospect theory. So how we deviate from more normative economic theory. Those things have been around now for some time. And I think, if you go to most investors and say, do you understand roughly what overconfidence and framing and so forth? I think most people understand that. The challenge, exactly to your point, is actually weaving this into your day-to-day processes. And I think that the next step of managing and mitigating these kinds of cognitive mistakes is where we need to put our effort today. And I think that so we've actually made, I think, quite little advancement in this. So it becomes some really interesting questions about what to do about that. We wrote a piece last year called Methods to Improve Decisions. And it was an explicit effort to try to introduce a handful of tools that an investor or an investment organization could try to put into place to at least make a dent on this problem. But it's not easy. The other thing to me is what's also interesting is we need to distinguish, and we talked about this a few moments ago. We really need to distinguish between two things, and I think that many people don't make this distinction clear enough. The first is how you and I operate as individuals. So, somebody could put a spotlight on us and follow us around and see how we make decisions. And in doing so, by the way, it's very clear that individuals are suboptimal. They're not making perfect decisions. But the second level of analysis is that of the market itself, which is really the collective of individuals. So as a consequence, we go from psychology to really sociology, how groups interact. And there's another area where I think that it's very difficult for people to make that jump. I'm persuaded that for as long as you and I are on this earth, we're going to continue to see these collective behaviors of, euphoria and despair, and these markets running to extremes. What we know is markets are generally pretty good. And we also know that markets episodically go to extremes. And I'm just not sure there's anything, whether in the literature or in our learning, that suggests that pattern is going to stop anytime soon. The booms and busts have been happening for as long as, from the first time the first market opened up, right? If you're a historian of the market, this has been going on for 400 or 500 years. I'm not sure it's going to stop anytime soon. So but I would just say, if you're a trader or an investment professional, the thing you really want to think about is what can you do in your environment and in your process to help you manage or mitigate the kinds of cognitive mistakes you're likely to make, right? So you have to embed it in your process and embed it in your environment. That's the key. So it's offloaded to some degree. It's whether it's checklists or certain procedures you go through to make sure you've thought about things thoroughly. You need to offload it to your environment and your process to make sure that you're doing the best you can.
Let me dovetail one last question into that response and where I went with that initially. So you've been a professor, you've taught young people. I'm curious your perspective on where we are today in the classroom for those pursuing the MBA, the finance degree. Have the tracks moved? Are younger people getting a different vantage at this since it's thrown at them at a young age? They're not having to learn it all as we've all had to see it come out. Is there a difference in how young people are accepting these subjects?
It's a great question. I think that, certainly the possibility of learning about these things is much greater today than it was a generation or two ago. As you point out, I'm starting my 23rd year at Columbia Business School. And when I first started, there were no behavioral finance courses. And what I would recommend the students do is go take a negotiation course, because that was the one area where you could start to get some of this stuff, some of these ideas were leaking in. Now there are these behavioral courses. But I have a personal anecdote on this that really brought this home to me. One of my son's high schools decided to start a Center for Leadership, which is fantastic. And of course I applauded that. And then they decided, what are the key cores to our curriculum? And so they lay out their cores, and they're all things that were certainly fine and admirable. But what was not included was decision making. So there was no discussion about how leaders should make decisions. So I went to the head of the school and I said, first of all, I think this is great and so forth, but I'm not sure that we can, in a serious fashion, talk about leadership without providing these young men and women with the tools to think about decision making. It was almost like a surprise. So I think that you can certainly go through school today as a young person, through high school and through college, and not really get concrete exposure to these concepts on decision making. That is something I would like to see. I know there are a couple initiatives out there. I would like to see that much more explicit. Even things like, understanding the scientific method and how that can inform the quality of your thinking. Understanding, as we've talked about before, heuristics and biases. Understanding how our minds work and how we love to attach causes and effects, and as a consequence, that messes up the way we think about a lot of things. And just get people to think, as you mentioned, one of the first things you talked about is, appealing to the outside view, these reference classes, these base rates, versus only our own experiences, our own intuitions, and trying to bring that suite of tools to our young people. Now, I think that probably junior high school or I guess they call it middle school, is probably a little young for that. But certainly our juniors and seniors in high school, and certainly our college students, are fully capable of understanding all these concepts, and we should be much more explicit in teaching them. So I think we've made progress. That stuff is out there, but there's much more. There's much more that we can do. I try to talk to my own kids about this stuff, and using the kinds of terms that we've been talking about. I think there's not enough of it out there.
I think one of the things that young people should be lucky about is that they can reach out some of the names that I rattled off. And I was thinking of one more, Gerd Gigerenzer. All of these guys are accessible. They're all out there. And there's they open their mouths and it's just so much wisdom comes out. So I think that's one of the great opportunities with all this technology for distributing communication. It's just fantastic.
I agree with that. And Gigerenzer is a great example where, people struggle with understanding probabilities. One of his prescriptions is to change everything over to natural numbers, right? So instead of saying 2%, you say 2 out of 100. And 2 out of 100 is a lot easier to understand and visualize because it's much more concrete than 2%. So going from the abstract to the concrete helps people think in their thinking enormously. And so all these tricky probability problems, which can trip up even a statistician, and certainly people like physicians and people who should know better, translate it over to natural numbers, and everybody gets it, right? So it's stuff like that where you say everybody should have those tools in their toolbox, right? Everybody. It's
fun stuff, Michael. I like I said, you've inspired me to go off of these. I want to affectionately call them tangents for the last 15 years. So listen, your books, More Than You Know, The Success Equation, Think Twice. You are on Twitter. You post really cool stuff on Twitter. People should follow you just for that alone so they can take advantage of all the free work that you're doing for them. Where else can we send them in terms of your major URL?
I think that's it, Mike. I have michaelmauboussin.com, but I don't post much stuff there. But that's where you can see all these, and there's some chapters from the books and so forth. Yeah, so that's those. You hit all the highlights.
Well, Michael, listen, I appreciate you coming on. Hopefully we can talk again in the future. Always great.
Mike, my pleasure. Take care.
Take care. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street. This is absolutely not for you.